So in the past few episodes, we've been talking about the skill sets that I think it takes to be in the self-storage business today. This comes from an article that I was fortunate enough to get to write for Inside Self-Storage. It was reprinted in episode 178. And so far we've talked about the first two skill sets, the ability to get in front of deal flow and the ability to analyze self-storage. Let's talk about the ability to get the right loan for self-storage. My name is Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and what I do is I support the small investor who wants to get in the self-storage business or who wants to strategically grow their self-storage business, do so in a way that creates true wealth and a fulfilling career. And I have training at creatingwealththroughselfstorage.com in the blog and training section, and at the Self-Storage Quick Start Academy or quickstartacademy.com. And debt, loans, gets a bad rap in our culture. Yes, I know there's a lot of people who are too far in debt. I've been too far in debt in life. But I remember early in my career, a very successful man telling me that if you're born poor and you don't go in debt, odds are you're going to die poor. And there's different kinds of debt. I've written articles on that too, good debt and bad debt. But think about it. If you have debt that gives you low-cost money and someone else is paying that debt off, and every month your net worth goes up because the loan's going down and someone else is paying it off, that's not a bad situation to be in. Let's talk about the role of financing and debt in the self-storage business today. It's never been more critical than it is now. What's required to be in the business of getting in the business of self-storage is the ability to get the right kind of loan. Not just a loan, but the right kind of loan. So let's take a look. Let's go up and just look at the business of self-storage itself today. So in reality, what you're doing is, at this 40,000 high view of business, you are buying assets or building assets that are going to generate operating cash. That's the business of self-storage. You're buying assets that are going to generate not just any kind of cash, but operating cash. And that's what you're doing. Now, if you had enough money, you could just buy the facility and put no debt on it. But in reality, especially today, that's not a good idea to do. It would not be a smart move to pay all cash for a existing self-storage facility today. Or probably not even to build one with all your own cash. Why? Well, let's think about it. So if you've got cash sitting there, what is your goal? Your goal is to put that cash somewhere that will generate a good return for you, an acceptable return for you. So in today's world, if you're buying a fairly good facility, what's it going to sell on? It's going to sell on a, 6 cap, 5 cap, maybe a 7 cap? I doubt it. But let's just say a 6 cap. So in other words, what that's saying is you're taking your money, you're buying assets that are going to generate a 6% return for that cash. Is that a good deal? Well, I wouldn't do it. I mean, I can most likely put that same amount of money in a mutual fund and get a 6% return and not have to worry about running a business, hiring and firing people, and all the stuff that goes through, you got to go through to get the 6% return on that. That's where financing comes in as we're looking at this high level. What financing does is it allows you to get a large percentage of the cash to buy the asset that's going to generate the income at a lower cost. Let's say that you buy it at a 6 cap, but your money you're borrowing is at 4.5%. Right there, before you've done the first value add play, you're making 1.5% spread on the cost of the capital, on the cost of the money to buy the assets. And then if you take and add some more income and generate more, let's say you do an expansion and you spend more money to generate assets, your cost for the expansion is going to be much less per square foot than the acquisition. And when you blend the two together, you're getting an acceptable return. You're pushing 10%, 12%. Now, that's where I would put my money, into something that's generating that kind of return for the amount of effort and calories it takes to run a self-storage business. If I'm just going to get 5, 6%, I just soon put it in a mutual fund. A lot less work for me. So in theory, if you could use all the bank's money at 4.5%, that would be a good thing, right? Well, in theory, yes. But why financing has gotten its bad rap is because if anything happens and the cash flow from those assets goes down, the cost of the money to buy it isn't going to go down. It's going to remain constant. So cost you 4.5% a year to buy that money, to buy those assets, and the cash flow from the assets go down, you could be upside down. That's what has given debt a bad rap, and that's why banks want to have you have some of your money or some other cash in the deal. How much? Well, typically in today's market, a bank is going to want to see you put in 20, 25, 35% of your money, and they will loan you the rest at a much reduced cost, 4% to 5%. In our business model, I try to keep, or in the past, have tried to keep my cost of capital around 8%. So if I'm doing a 75% loan and I'm borrowing 75%, and that money costs me 4.5%, and I've got investors with a 10% preferred return, 25% of that money is costing me 10%, 75% is costing me 4.5%. You blend those together, I'm trying to get around 8%. And then if I can buy at a 6 cap and then add and expand on, and by the time I blend the cost of the expansion with the cost of the acquisition, and I'm generating 12%, I've got a 4% spread between my cost of capital and what that asset is producing. That's the game we play. Now, in reality, look, I know no one walks around talking about buying money to buy assets to generate operating cash. We just don't talk that way. But that's what's going on. When you're in the self-storage business, that's literally what's going on. You don't have people talking about the spread very often between your cost of capital and what those assets are generating in operating cash. But that's what's going on. So the financing component is a critical component because it is the lowest cost money you're going to be able to get your hands on. How do banks, and again, every time I'm doing any business transaction, my goal is to put myself in the mind of who I'm dealing with. So if I'm getting a loan, I want to put my mind it's a scary place to be, but in the mind of a banker or the bank itself. So what the bank is looking to do is to reduce its risk. Again, they're making 5% on their money. Their money's costing them something, costs them less than they're charging us, and their profit is that spread. And what they don't want to do is they don't want to give you or sell you that money and then have you not be able to pay it back. So how do the banks analyze the risk? Well, the banks have something that's called a debt coverage ratio. So most banks will want to see a 1.25% debt coverage ratio. What in the world is that? Well, a debt coverage ratio, all that means is, let's say that your facility generates $200,000 in income. It has $100,000 operating expenses. Your net income's $100,000. They're going to want to see that net income be at least 1.25% over the cost of their money or your loan payments. So if your loan payments are $100,000 a year to borrow their money, they're going to want to see that net operating income be at least $125,000. In 200 minus 100 equals 100. They're going to want to see that 100 net operating income be 1.25% more than what the debt service usually is. Well, what if I'm building and there's no money up front? The banks realize that. They're going to also assess their risk by how long it takes. They think it's going to take it to lease up. Another reason to get a good feasibility report. And what the debt coverage ratio is going to be when it's leased up. Now, they're going to look at your spreadsheets, but they're also going to rely on an appraisal to tell them what the value is going to be so they can calculate their debt coverage ratio. When I walk into a bank and I'm talking with them, I know what the debt coverage ratio is. And I know what it's going to be. And I know how much spread, how much risk there really is for the bank. And we address that when we talk. Can you see why a feasibility report is so critical when you're getting financing? Can you see why a good financial analysis with good financial reports like the Storage World Analyzer generates are important when you're going to get financing? So what's critical is you not just be able to get a loan, but you get the right loan for this project. You're also beginning to see why value add plays for the small investor are so critical. If you're buying on a 6 cap, it's hard to generate a good return that's acceptable for us for the amount of calories we've got to burn, even with low cost money of 4 to 5%. It's still hard at a 6 cap to get the kind of returns we need. That's why we almost always have to add more assets at expansion at less cost so we can get a much higher rate of return on the new assets. But we have the old assets that are generating cash to pay the debt service while we're building the new assets. You blend the two together. They're usually not home runs, but we can get an acceptable return by doing that. As we talked about last week in the financial analysis, that is a critical component of being in the business today for the small investor. And you're beginning to see why. You have got to be confident in what this facility is going to be doing after the value add play's done, what it's going to be worth, what the income is, what the debt coverage ratio is. You've got to be confident in those numbers. And you have to be able to sell it, demonstrate it, talk in a convincing way to a banker, your partners if you have any, or your investors if you have any, of what this facility is going to do. Because all anyone is seeing is this facility is coming in at a 6 cap and the current debt coverage ratio is X. So your ability to know what the future cash flows are going to be are important. That's why the analysis is so important. But in my world, that's why the reports we generate are so important. But what if I don't have 20% down? What if I don't have 25% down? But I still want to get into business and I still think this is a good deal. Well, there's alternatives. There's other places to borrow money or buy money than just the traditional bank. usually cost a little more, but they're out there. So, for example, an SBA loan, Small Business Administration loan, you can borrow instead of 70 or 75%, you can borrow up to 90% on an SBA loan. Now, in reality, you're not borrowing the money from the Small Business Administration. What's really going on is the Small Business Administration is insuring the bank a portion of that loan to the bank, and they're telling the bank what these different terms are going to be, and because it's riskier for you, banker, we're going to insure up to 50% of the loan for you. So it's really, you're not borrowing it from the money. What's really going on is an insurance program goes in place to help protect the bank. Now, usually those interest rates are higher, but the good news is the amortization period is also usually longer, which means your monthly, even though you're paying higher interest, your monthly debt service or loan payments are usually about the same as what a bank would be, because it's a longer amortization period. And usually there's no prepayment penalties and there's no payoff. Most bank loans you've got to do something with in 5 or 7 years, because they don't want to put money out at 4 or 4.5% for 30, 25 years, because they don't know what their cost of money is going to be in the future. SBA has a different agenda. They're insuring the bank, and you can keep that loan in place for 25 years if that's the amortization period. Probably the only commercial loan I know of that you can do that. So not only is the ability to get a loan, or in other words, get low-cost money to buy a certain percentage of the storage facility, not only is that important, but getting the right loan. You're talking to somebody who's gotten the wrong loans before, dealt with the wrong banks. It's not fun, I'm here to tell you. So it's important that you get the right loan for the project and the right loan for where you are in your evolution as being in the storage business. Now, when you go to talk to your lenders, after you've found an opportunity, you've done your analysis, it looks good, and you go talk to a lender, think about it like you're telling a story. I don't care how sophisticated people are, we're still in the storytelling business. So what I usually do is I usually will have a 1 to 1.5 page executive summary. And in this executive summary, I quickly go over the project. We're buying 25,000 square feet for $1 million. We're adding another 25,000 square feet at $800,000. When we're in it for 1.8, and when we hit stabilized occupancy, it'll be worth 3.2. Something that simple in the executive summary. Then, when you go into your financial analysis, that's when you go into all the details. I also put the selling package in there. I put any historical information I can get from the seller in there, and I always have a place for the feasibility report and our resume. So when I go tell the story to the bankers to ask them to loan money to me, this is what I have with me when we go talk and tell the story. And literally that's what you want to do. You want to tell a story of why this is a good investment, not only for you, but for them. The bank is going to be your partner in that deal. They're a good partner because they have the cheapest cash there is in the deal. I demand a higher return than they're going to get. My investors demand, if you have investors, a higher return than they're going to get. They're only looking for 4.5% return. Financing is your friend if you do it right. I also talk to many people who are not sure if they can even qualify for a loan. Believe me, I get that. I couldn't, and I still, to this day, there's some deals that I have to have other co-signers on because they're so big. I mean, I totally get that. What my suggestion is talk to a lender before you go approach them with a loan package or a request for a loan, tell them, look, I'm getting into business, here's what I'm looking to do, here's my financial net worth, tell me what you think my odds of getting a loan are, what you'd be looking for. Also keep in mind, the day you close on that facility, your income just went up. So if you're got income and you're not sure if your income's enough to qualify for the loan, just remember you've also got the income from that facility in place whenever you're applying for a loan. What I did was I looked for partners who would sign on the loan with me. Ultimately, I had a vision for a storage company. I needed people to help me grow, fulfill that vision, and I found some good partners who helped me run the company, have some net worth, and will sign on the loans, and together we're fulfilling on the vision that I created for the storage company. They bought into it and want to be part of it and are willing to sign on the loans. If you're doing more than 1 or 2 facilities, odds are you're going to probably need some partners. So in today's market, the ability to get not only a loan, but the right loan to help assist in the return for this storage facility you're going to be putting into service, that's the business you're in if you're in the business of getting in the self-storage business. So thank you very much. I look forward to being with you next week. My name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. That's the tool we use as we create our financial analysis and financial reports that we show to the bankers as we're getting financing. If you're not using it, I invite you to, and go look at storageworldanalyzer.com or Creating Wealth Through Self-Storage. Click the Storage World Analyzer tab. Thanks. I look forward to being with you again soon. Bye-bye.